There's a number on your bank account screen right now. You check it, you trust it, you spend based on it. But here's what most people never consider. That number might not represent anything real. Not in the way you think, not in the way money is supposed to work. And if you trace that number back far enough, you'll find something deeply strange. The money you're spending today was never actually created. It was conjured, written into existence by a promise built on another promise, built on another, stacked so high that nobody can see the bottom anymore. And the strangest part? This isn't a conspiracy, it's the design. This is the story of how the entire global economy runs on money that doesn't technically exist, why that's somehow normal now, and what happens when everyone realizes it at the same time. Let's go back to 1971, August 15th. President Richard Nixon appears on television and makes an announcement that will quietly reshape human civilization. He's ending the gold standard. What that means in plain English is this: the US dollar will no longer be backed by gold. It will no longer be redeemable for anything physical. From that moment forward, the dollar's value would be based purely on trust, on belief, on consensus. Before this, money had a tether. If you held a dollar bill, you technically held a claim on a tiny fraction of the gold sitting in Fort Knox. It was abstract, but there was a link. After Nixon's announcement, that link was severed. The dollar became what economists call fiat currency, money by decree, money because the government says it's money. Most people didn't notice. Life continued, but something fundamental had shifted. The rules of money had changed, and almost nobody understood what that actually meant. Here's where it gets strange. When you deposit money into a bank, you probably think the bank holds on to it, that it sits there safely stored, waiting for you to withdraw it. But that's not what happens. The bank doesn't keep your money. It lends it out, almost immediately. This is called fractional reserve banking, and it's been the backbone of modern finance for over a century. Here's how it works. You deposit $1,000. The bank is required to keep a small fraction of that in reserve, let's say 10%, so $100. The other $900? The bank loans it to someone else. Now that person takes the $900 and deposits it in their bank. That bank keeps $90 and loans out $810. That money gets deposited again, another loan, another deposit, on and on. By the time this cycle completes, your original $1,000 has turned into nearly $10,000 in the economy. It's been multiplied, not by printing new bills, not by mining new gold, but by the system itself, by loans, by promises to repay. The money supply expands not because more money is made, but because more debt is created. And here's the twist. Most of the money in circulation today was created exactly this way, through loans, through debt, through banks saying yes to credit applications. Roughly 90% of the money that exists in the world right now is not physical cash. It's digital entries in bank databases, numbers that were typed into existence when someone signed a loan agreement. That's not an exaggeration. That's how it works. Now you might be thinking, okay, but someone has to pay those loans back, right? Doesn't that balance it out? Not really, because there's a trick hiding inside the math. When a bank creates a loan, it creates the principal, the amount you borrowed, but it doesn't create the interest. You borrow $10,000, but you owe back $12,000. That extra $2,000 has to come from somewhere, from another loan, from another expansion of credit, from more debt. This creates a system where the total amount owed is always larger than the total amount of money in existence. It's mathematically impossible for everyone to pay back their debts at the same time. There isn't enough money in the system to do it. The only way the system continues is if debt keeps growing, if credit keeps expanding, if people keep borrowing. The moment borrowing stops, the whole thing starts to collapse inward. And that's exactly what happened in 2008. The financial crisis wasn't caused by a single bad decision. It was caused by the system reaching a breaking point. Too much debt, too many promises, too many loans built on loans built on loans. When people started defaulting on mortgages, it triggered a chain reaction. Banks that had loaned money suddenly couldn't get it back. Other banks that had loaned money to those banks couldn't get paid. The web of promises began to unravel. Trillions of dollars in value vanished, except it didn't vanish. It was never really there in the first place. It was theoretical money, credit money, promise money. And the moment the promises broke, the money disappeared because it was never tangible to begin with. So what did governments do? They created more money. Central banks around the world launched something called quantitative easing, a polite term for printing money. Except they didn't print physical bills, they created digital money. Trillions of dollars, euros, yen, pounds, conjured into existence and injected into the financial system to stop the collapse. It worked, sort of. The global economy stabilized, but the problem wasn't solved, it was delayed. Because now there was even more money in the system than before, money that wasn't backed by productivity, money that wasn't tied to anything real. Just more numbers in more accounts, inflating a system that was already too inflated to begin with. Fast forward to 2020. A pandemic hits, economies shut down, millions lose their jobs, governments panic, and once again the solution is the same: create more money. Stimulus checks, paycheck protection programs, expanded unemployment, trillions more created overnight. In the span of 2 years, the United States alone increased its money supply by roughly 40%. 40% in 2 years. Money that didn't exist in 2019 was suddenly everywhere in 2021. And people noticed, not because they understood monetary policy, but because prices started rising. Groceries cost more, rent went up, gas, cars, electronics, everything. Inflation arrived, fast and undeniable. The extra money in the system was chasing the same amount of goods, and prices adjusted accordingly. Now here's where the narrative gets uncomfortable. Governments and central banks insisted this inflation was temporary, transitory they called it, a short-term side effect of the pandemic, supply chain disruptions, nothing structural, it would pass. It didn't pass. Inflation kept climbing, and central banks were forced to admit what many economists already knew: they had printed too much money. The system was heating up, and the only way to cool it down was to reverse course, to raise interest rates, to make borrowing more expensive, to contract the money supply by slowing the creation of new debt. But here's the problem. The entire economy is built on cheap debt. Businesses borrow to expand. Governments borrow to function. Consumers borrow to live. When interest rates go up, all of that becomes harder. Companies can't grow. Governments face budget crises. People can't afford mortgages. Raising rates fights inflation, but it also risks triggering a recession, maybe a depression. Central banks are stuck between two bad options: let inflation run wild or choke the economy and hope it survives. This isn't theory, this is happening right now. Let's zoom out. Global debt, public and private combined, is currently $300 trillion. That's more than 3 times the size of the entire global economy. It's a number so large it's almost meaningless. But here's what it represents: $300 trillion in promises. Promises to repay money that was created out of nothing, backed by nothing, sustained only by the belief that someone, somewhere, will eventually make good on it. And the system only works if that belief continues. The moment people stop trusting the currency, stop believing the debt will be repaid, stop accepting the numbers on the screen as real, the entire structure begins to crack. We've seen it before: Weimar Germany, Zimbabwe, Venezuela. Currencies that collapsed because governments printed too much money and people stopped believing in it. The difference now is scale. This isn't one country, it's all of them: the US, Europe, Japan, China. Every major economy is running on the same model: debt-based money, fiat currency, systems where the money supply is tied to not resources or production, but to the willingness of banks to lend and people to borrow. It's a system that requires infinite growth, infinite confidence, infinite expansion. And nothing is infinite. So what happens next?
Some economists argue we're fine, that fiat money is the best system we've ever had, that it's flexible, adaptable, capable of responding to crises in ways the gold standard never could. They point to decades of relative stability, to rising living standards, to the fact that, for all its flaws, the system hasn't collapsed. Others argue we're living on borrowed time, that the debt is unsustainable, that inflation will either spiral out of control or central banks will trigger a deflationary crash trying to stop it, that the money we're using is an illusion held together by collective belief, and belief is fragile. Both sides have data, both sides have models, neither side knows for sure. Because here's the truth nobody wants to say out loud. We're running a global economic experiment in real time, with no historical precedent. Fiat currency on this scale has never existed before.